Hello, welcome back to Reflections on Investing with the Cornell Capital Group. And today I'd like to introduce you to a guy named Steve Ross. Most investors haven't heard of Steve. He was a professor of finance at Yale for many years. But they should have heard of him because he developed the arbitrage pricing model, which is the basis for almost all factor investing engaged in today. But we're going to talk about something a little bit different than factor investing. We're going to talk about information and stock prices. And in a series of lectures he gave at Princeton, Steve Ross had this to say about information and stock prices. And I'm quoting, "It is one thing not to be able to predict what asset returns will be, since they depend on news. And news, by definition, is information that is yet to be revealed. It is another thing, though, to observe the movement of prices and not know why they moved after the fact. I am particularly troubled that contemporaneous news seems to explain so little of the contemporaneous motion of prices." And along this line, Larry Summers and I both did similar research projects. Yes, this is the Larry Summers who's been talking about inflation. Here's what we did. I'll explain what I did, but what Larry did is pretty much the same thing. I took 25 years from 1985 up through 2010. And over that 25-year period, I selected the 50 biggest moves in the stock market. Biggest, of course, being the crash that occurred in 1987. And I then went back to all the news stories and tried to determine whether there was news, fundamental news about cash flows or discount rates that could explain the large movement in prices. And the answer, even for the biggest moves over a 25-year period, virtually none of them could be explained by contemporaneous fundamental news. These big movements seem to occur for reasons that no one could really understand. Though, of course, after the fact, the press would make up some story like fear of inflation or, what was another one? Profit-taking or concern about the international situation. But these were all made up after the fact. They were not real events. An example of a real event would be the terrorist attack on New York City. That would be something you would predict. But in most cases, you don't find anything. Now, the reason for this big lead-in, it shows that over the short run, stock prices are virtually unpredictable. And I want to give you an interesting recent case now. So let's go over to the computer, and we're going to take a look at what's happened the last couple months. So on September 13th, 2022, when the government released the CPI, the market opened and it tumbled. And by the end of the day, as this headline says, Dow tumbles 1,200 points for worst days since June 2020 after hot inflation report. So that was the September inflation report. Now we roll forward to October, and the market is concerned about the October report. And it's going to be released at 8:30 in the morning. And earlier that morning, 3, 4 in the morning, the futures are trading. And the financial press noted that futures were jittery ahead of the US CPI data to come out at 8:30. Then it comes out, the market opens at 9:30, and Wall Street opens sharply lower after hot inflation data. The Dow was down over 500 points within a few minutes. Now that seems to make sense. When there was bad inflation news on September, the market was down 1,200. Now it's bad again. It's down over 500. But as the day goes on, well, we're now in mid-morning and Wall Street is down, but it's actually not down as much as it was. It's just fears of a big rate hike. Now we move into early afternoon. Wall Street turns around to trade higher, led by cyclical stocks. My goodness, why are cyclical stocks leading it up? And then finally, Wall Street ends up 2% after sharp reversal. Technicals help. Financial press often says things like technicals help, but why did they help on this particular day? Why wasn't the inflation news bad like it was the previous month? The problem is that short-term, this is what Larry Summers and I both found, that short-term movements in market prices are virtually not only unpredictable, but often are unrelated to contemporaneous news, as Steve Ross had said. Perhaps Lloyd Blankfein, the previous chairman at Goldman Sachs, summed up the situation best when he said, "This is one of those trading days where if you really had the news in advance, that someone had leaked you, told you what was going to happen, you really would have lost a lot of money." And the reason you would have is this relationship between contemporaneous news and stock price movements is so weak that even with the news, you can lose money. This is why at the Cornell Capital Group, we think the only rational way to invest is based on long-term estimates of fundamental value. Yes, the market's going to move around a lot. Yes, you'll have negative periods and positive periods. But fundamental valuation, we believe, and we think the research demonstrates, is the only method for long-term investing. This has been Reflections on Investing with the Cornell Capital Group. Thank you for joining us, and we'll see you next time.